Hi, this is Craig, the options linebacker. This is the weekend report for Sunday, January 9th. If you like to follow and trade the markets and use technical analysis, which is what most retail traders do, because we're not on the floor and we don't see the pulse of what's going on between the big institutions and the locals, then these are strange times because none of the indicators for technical analysis are particularly working well. So the standard ones that we're looking at, like the stochastics, will stay overbought literally for months at a time and are offering us really no edge at that point to be able to identify overbought opportunities that are crossing to the downside. We have the typical leading indicators like the MACD histograms, which are normally a very, very accurate indicator and show when things are really slowing down and they're just failing. We just don't have any leading signals that are happening from the standard technical indicators. So this is where we have to dig a little bit deeper and really understand what price is telling us. Now let's do a little bit of top-down analysis starting with the monthly chart. And what I'm going to look for in this case is during bull markets, what are the corrections that we've seen? Really over the last 15 years we've seen 3 individual bull markets, and I'd certainly count this one that we're in right now as a bull market since March of 2009, especially since the price has just taken out the prior swing high from April. We now have a change in polarity back to an uptrend. So with that established, what I'm going to look for is corrective periods. And one of the first one that stands out to me was back in this area in 1998. This is a long-term capital management problem that we had. And at that point, markets had been going straight up. And this was really quite a panic at that time because everybody thought the bull market was over. And notice what happened is that it went dramatically higher after that correction. Now we did have a bear market. We're not going to talk about those in 2000 and 2007. What we're going to focus on is these bull markets, and we're going to look for these corrective periods. The next one really of any significance was in 2006, during the summer of 2006. This didn't really even qualify as a corrective period. It wasn't even a 10% correction. In fact, we never got a 10% correction all the way up here during this bull market. But it was really the first one that kind of threw a shot over the bow and got people worked up from the 2003 to 2006 time frame. And we can see that it went dramatically higher. In fact, even in 2007, early in 2007, we had a small corrective period as well too, and you can see the effects of that. Now, as we go over to 2010, we can see that what we had in the summer of 2010 was a very deep corrective period. Actually, it was a 38.2% retracement. It was actually a very, very normal and at that time very necessary corrective period. So let's see, based on what we've learned about previous corrective periods, what we might be able to expect from this one. The first correction to go under the magnifying glass is from 1998, and it was about 265 points on the S&Ps to the downside. And we can see that the reaction that it produced was about 500 points, so almost a 2-to-1 effect from the correction versus the eventual bounce to the upside was almost 2-to-1. Now moving on to 2006, what at that time was felt like a pretty severe correction actually was just a little baby, about 108 points to the downside, and now we know that we can do that in about a day. Back then it was a very unsettling retracement because of the fact that the markets were so quiet back then. So 108 points to the downside felt like a new bear market kicking in. And we can see that we had a 243 point reaction to the upside before any weakness kicked in. And actually weakness kicked in immediately, another 98 points to the downside, and we had 177 from that. So you can see that we're kind of preserving this 2-to-1 relationship, although it's approximate. It's not going to be exact, but it is approximately a 2-to-1 reaction based on this correction. Here's today's chart, and what we had this summer was a 210 point correction to the downside, and what we've seen so far is about 267. Now, based on what we've already established in the character of the S&P and how it handles these types of corrections, when everybody gets a little too bearish down at the bottom, ultimately we do slingshot higher, and that's exactly what we're seeing right now. and also certainly aided by the Fed, but notwithstanding, we are slingshotting higher, and this is a very normal reaction to this because people just get too bearish down here. And so if we apply our 2-to-1 ratio, then we would expect something around 1400 or so, which is coincidentally what a lot of the big analysts are calling for this year. What I find interesting about this is that it lines up with so many other things that we're also doing. Now remember from this summer that we talked about, hey, believe it or not, I'm seeing an inverted head and shoulders pattern here. And we noticed that right around here in late August, although we had sort of, bite our tongue when we said it because of the fact that it looked like we were just heading right down for S&P 600 again. But here we are, we've already met the upside target for that inverted head and shoulders pattern, which was around S&P 1240. Now, the next thing that we've seen in the markets is a cup and handle pattern. So if you just sort of scrunch up your eyes and call all of this a cup, this is almost a perfect handle on that cup and handle. And the target for something like this is going to be the depth of the cup, which again puts us up roughly, this doesn't have to be exact, but it's roughly right around 1400 or so. So that does line up with what we're seeing in the markets again. If you really want to go crazy with the fractals, what you can also do is look for the larger time frame period and say that this is a cup and handle. And that lines up with the cup and handle again too. And I don't even want to guess what this one could lead us to. But if we're going to continue to print money and debase the currency, then I wouldn't put it above anything to see that accomplished in the next couple of years. Remember, folks, what counts is not how you and I feel about the economy. It's not what you and I feel about the unemployment rate or anything like that. It's what is reflected in the charts. That's really all that matters because the charts are trying to discount future price action. So don't allow your emotions to get you stuck in the past. Just focus on what the charts are trying to tell you. Thanks for watching, everyone, and have a great weekend. Now, we're not trying to double our accounts every single month. We just look for a consistent income every month, and we're very, very defensive and very conservative about it. But we're 22 out of the last 25. We're about to become 23 out of the last 26 and 16 out of the last 17, and that's in a couple of weeks. So learn more about what we do at optionslinebacker.com or shoot me a note. We do have a new product out. We have a new advanced trading guide is now available as of last week. So if you haven't been able to learn the options Greeks, which is what the professionals do, this is your chance to do so at a very low price, a very unique program. It's a combination of ebook as well as video resources. So go to the Options Linebacker products page for more information. The price will go up tonight, so take action now. And don't forget your free report so you can figure out what it is that we do and why what we do is rather special. So go to the free stuff tab on optionslinebacker.com. See you next week, folks. Take care.